Hi friends, this is the generation of technology. So we at Iyer Commerce Classes decided, why not use technology for the sake of studies, for the benefit of students. So we have compiled all the critical points, the basics of every chapter, rather the most important chapters at one place in the form of a mobile app, which you can listen to it whenever you want, at your convenience, without requiring Wi-Fi, no internet required, no 3G, no 4G. You just have to download in your mobile and listen to it at your convenience. My advice, listen to all the chapters at least thrice a day till your day of the exam, and I'm definitely sure you'll be able to remember all the critical points during the examination. So friends, take this mobile app, use it and score maximum marks in your examination. Wish you all the best. Now friends, let us come to one of the most important chapters in financial accounts, and that is amalgamation, absorption and external reconstruction of a company. What is amalgamation? Two companies joining together and forming a third new company is called amalgamation. What is absorption? One existing company taking over the business of another existing company is called absorption. What is external reconstruction? When a new company is specially formed to take over an existing loss-making company is what is called external reconstruction. Friends, in all the above cases, there is a new company which is also called purchasing company, which takes over the assets and liabilities of the old company, which is also called selling company. When they take over the assets and liabilities of the old company, assets means only the realizable assets and liabilities means only the external liabilities. The new company will take over only the realizable assets and they will take over only the external liabilities. In exchange for the assets and liabilities taken over, the new company has to pay a price, which is called as purchase consideration. That is the amount which the new company has to pay the old company for taking over the company. The purchase consideration can be ascertained in three ways. Number one, lump sum method. One single lump sum amount will be agreed between the parties concerned. Number two, net asset method. Here we have to apply one formula. Assets taken over by the new company at agreed value less liabilities taken over at agreed value. Assets taken over minus liabilities taken over, that is what is called purchase consideration. In this method, friends, you have to remember 2 points. Number one, you will write only the assets and liabilities which are taken over. And number two, you will always take the agreed value. Third one, that is called net payments method. All payments made by the new company to the equity shareholders and preference shareholders of the old company, add them together is what is called purchase consideration by net payments method. Once you calculate the purchase consideration, the next step is to find out what is called discharge of purchase consideration. How the new company is going to pay the old company. The new company can discharge the purchase consideration either by giving equity shares or preference shares or debentures or cash or a combination of all these four put together. That is what is called the discharge of purchase consideration. Now friends, once you calculate the purchase consideration and discharge of purchase consideration, now what to do in the examination? Given, you will be given in the problem balance sheet of the old company. Number two, and terms and conditions of amalgamation. What is required from you Number 1, you have to close the books of the old company. Number 2, pass journal entries in the books of the new company. And number 3, you have to prepare the new company's balance sheet. Now let us see how to close the books of the old company. For that, you have to open various accounts. Number 1, realization account, equity shareholders account, preference shareholders account, new company account, cashback account, equity shares in new company account, preference shares in new company account, debentures in new company account, last one, liabilities not taken over account. If the new company takes over all the liabilities, then no account will be opened for them. You will be opening a separate account for liabilities only if that particular liability is not taken over by the new company. Now friends, once we have opened the account, now let us follow the steps. Step number 1, transfer every item from the given balance sheet as under. From the asset side, let us start first. Fictitious assets from the asset side will be transferred to equity shareholders account debit side. Second one, cash back, if taken over by the new company, will be transferred to realization account debit side. If not taken over by the new company, it will be transferred to cashback account debit side. And all remaining assets, whether they are taken over or not taken over by the new company, will be transferred to realization account debit side at their book value. From the liability side, equity share capital will be transferred to equity shareholders account credit side. Preferential capital will go to preference shareholders account credit side. Any reserves and surplus will go to equity shareholders account credit side. And all remaining liabilities, if taken over by the new company, will go to realization account credit side. If not taken over, we have already opened a separate account for that. It will be transferred to a separate liability account credit side. Step number 2, entry for purchase consideration. The entry will be new company account debit to realization account with amount of purchase consideration. Step number 3, entry for discharge of purchase consideration. The entry will be equity shares in new company account debit, preference shares in new company account debit, debentures in new company account debit, cash bank account debit to new company account. Step number 4, sale of assets not taken over by the new company. Entry will be cashback account debit to realization account. Step number 5, for payment of realization expenses or liquidation expenses by the old company. Entry will be realization account debit to cashback account. Note, if the new company agrees to pay the realization expenses of the old company, then the next entry will be cashback account debit to realization account. Step number 6, for payment of liabilities not taken over by the new company. Friends, the entry will be liability account debit to cashback account. Any difference in the liability account after the above payment should be transferred to realization account. Step number 7, payment to preference shareholders. Preference shareholders account debit to shares or debentures in new company account to cashback account. Any difference in the preference shareholders account after the above payment should be transferred to realization account. Step number 8, you will close the realization account and you will try to find out the profit or loss on the sale. If profit, the entry will be realization account debit to equity shareholders account. If loss, equity shareholders account debit to realization account. So any profit or loss in realization account will be transferred to equity shareholders account. Step number 9. The last one, payment to equity shareholders. You will close all the remaining accounts and transfer the balance to equity shareholders account. The entry will be equity shareholders account debit to shares or debentures in new company account to cash bank account. And with this, friends, remember the equity shareholders should tally. Now, journal of new company. First entry for issue of shares. Entry will be cash bank account debit to share capital account to securities premium account. Number 2, for preliminary expenses paid. Preliminary expenses account debit to cash bank account. Number 3, for business purchased. Business purchase account debit to liquidator of old company account with the amount of PC. Number 4, for assets and liabilities taken over. Entry will be assets taken over account debit, agreed value to liabilities taken over account, agreed value to business purchase account with the amount of PC. If the debit side is short, you will write goodwill account, and if the credit side is short, it will go to capital reserve account. Step number 5, for discharge of purchase consideration. The entry will be liquidator of old company account debit with amount of PC, discount on debentures account debit, face value minus issue price, to equity share capital account with the face value, to preference share capital account with the face value, to debentures account with the face value, to cashback account, to securities premium account, issue price minus face value. Step number 6, for realization expenses of old company paid by the new company. The entry will be goodwill or capital reserve account debit to cash bank account. Step number 7, for payment of liabilities taken over from the old company. Entry will be liability account debit to share capital account, face value, to debentures account, face value, to cash bank account. Entry number 8, for elimination of mutual debts. Entry will be creditors account debit to debtors account, or sometimes bills payable account debit to bills receivable account. Number 9, for elimination of unrealized profit in stock. Entry will be goodwill or capital reserve account debit to stock account. And friends, the last entry for carry forward of statutory reserves. Entry will be amalgamation adjustment account debit to statutory reserve account. Now in this entry, statutory reserve means what? It will be investment allowance reserve, export profit reserve, foreign project reserve, etc. Remember the entry, amalgamation adjustment account debit to statutory reserve account. Thank you, friends. Just follow the steps mentioned and given here. You will become very thorough in amalgamation, absorption and reconstruction. Thank you.